potential opportunities. They are always there in the newspapers, but people, I don't know why they read or buy newspapers. And for example, when the country announced the possibility of becoming an oil giant, it was welcomed with enthusiasm and joy by the nation. But just recently, an article popped up, right? And it claims that our oil is commercially unviable, meaning that they are not seeing any sign of making money off of this oil as of the moment. I would say as of the moment because these things can never really be finalized until it is announced by the people who are in charge, right? But this would obviously, and it has directly affected the share value of the project, obviously. So by taking off $400 million they mentioned to minimize risk, obviously this has reduced the confidence of the investors, number one. Also reduce the value, the share value of the investment, like I mentioned before. And if proven that indeed it is unprofitable, investors could be losing their investments and gain zero on their investment. So by taking off $400 million they mentioned to minimize risk, they reduce the confidence of the investors, number one, and they also reduce the share value of the investment. In other words, keep that risk on investment in mind, right? So all the trending news, keep updated at least by reading a newspaper once in a week. At least once in a week, right? And as a policy holder, you need to understand the subject of interest rates also, because since insurance deals with money just like banks, well, interest rates affect the performance of your investment and monetary value of your insurance policies. So otherwise known as buying power, purchasing power, which we will get into a bit later on in the discussion as we actually make more episodes. Just book note that one. Now, what is repo rate? Well, repo rate or repurchasing rate, a good friend of mine misused this word, and it actually inspired me to do a research on that one, just to also give people a broad understanding of what really repo rate is. So repurchasing rate or repo rate is a tool or indicator used by central banks of countries, in other words the Bank of Namibia, in order to determine at what percentage they can borrow money to commercial banks like FNB or Bank Benduk, Standard Bank, etc. Now these banks that are typically known as commercial banks, these banks are the ones now that actually lend to the rest of the people, and otherwise deemed as consumers, right? So which now these banks lend to you as a consumer or loan taker, regardless of whether it is for personal use or for business purpose, right? If the rate is at a low, then that means that it is favorable for the consumer to take a loan, say from FNB or Bank Benduk, because the interest rate that they will be paying on their loan will be very low compared to when the interest rates are high. So often they are lower to encourage more borrowing or lending to stimulate economic growth in terms of a slump or slow economic activity. So the borrower gets to pay a low interest rate on the borrowed capital, as mentioned, and the reverse is true. High interest rate means that borrowing is going to be expensive on the interest that the consumer is going to be paying for the loan that they borrowed. So, okay, big deal. What does that have to do with the insurance industry? Well, repo rates honestly affect home loans, car loans, and personal loans. But our main focus on this is the mortgage bonds, otherwise known as home loans and investment, because the higher the repo rate, then the more interest you pay on your home loan, right? And the slower the return on your investment. Hence the reason you need patience when it comes to investments, right? And which will now cause you to pay a large installment on your mortgage and force you to increase your monthly premium on your investment. That's why we do come back and we ask you to increase your premium, not because we want more commission, but because we know that if you stay at that rate, then know that you are actually just going to be getting a small amount of return on your investment. So keep that in mind. For better returns, you need to always keep up with these trends, right? So don't be fooled to say that, say for instance, you have a $5 million life cover, then you pay less for your mortgage. No, it depends on the interest rates, especially the repo rates. So also the value of your loan determines how much you pay on your installment, right? For example, during the COVID-19 pandemic, economic activities of all countries slowed down and some obviously business restrictions was happening. So that slow movement of economic activity so needed to be adjusted that the central bank started cutting rates just to accommodate or stimulate economic growth. So the governments were busy cutting rates, which, like I said, meant favorable times to get a loan on low interest rate. That is why more properties was actually being bought during this pandemic era compared to now. So awesome. Now, what is inflation rate, man? Well, the rise or increase in the cost of goods and services provided in a country. So whether it is food, non-edible commodities or services, those are affected by inflation rate. This is easy to check because you can just go out to any grocery store and just record the price changes in the goods that you buy for everyday use at your grocery store. So that is how you keep up with inflation rates. Higher prices indicate an increase in inflation rate, which is not good for the consumer because the more you pay. But what is interesting is that since insurance companies act as intermediaries, basically people who collect money on behalf of a collective, a group of people to invest, right, in different kinds of asset classes, like I mentioned before. So they channel this money into the economy by either lending it to borrowers at an agreed rate, or it is often given to their fund managers to invest, let's say in bond markets or real estate, which are the two top markets in an economy, if I would say, in my opinion. And a high repo rate or inflation means that the value of the investment is reduced, therefore making no profits to share with the investors. That's why sometimes you find you've been paying for your investment or investing money, but then the returns are slowly just coming in and they are not coming at the pace that you actually expected, right? Similarly, if the repo rate is low, then the investment is either neutral or it is losing value or it is just totally losing. This is why the insurance companies want you to invest for a long term, because they do it for long term too, minimum being 10 years.